Good morning, everyone. My name is John Paul, DayTradeToWin.com. I'm adding the Atlas line to my chart here. I'm going to show you today, July 31st, 2015, the signals that the Atlas line produces. Let me just adjust my account here. Usually I like to trade between 8 and 12 contracts. That's my threshold, especially if you look at the ATR at 3 points. Many traders have the Atlas line software, so the signals that you're seeing here in this video should be identical to the software purchased through DayTradeToWin.com. And let me just adjust here the template for my ATM strategy. The ATM strategy is based off of getting into the market and then having and executing a strategy to exit the market.
Order pending.
And so
Order filled.
the signal produced today, 2175, can be entered on limit or at the market. When you enter at the market, I would expect about a tick of slippage, and that's exactly what I got, a tick of slippage. And now we have to manage the trade. The problem a lot of traders have in managing the trade is that they always want the same amount of profit and the same stop regardless of the conditions. And so what I teach, and I have plenty of videos on the website as well as on YouTube displaying exact criteria for knowing why am I going for 3 points of profit, why am I going for 4 ticks of profit. It has to be rule based. So if you look at the current chart and you look at the ATR indicator that I have displayed below, you can see that the current conditions are about 11-12 ticks. So in determining what I can expect out of this trade, look at this ATR, the average true range, and it will always tell you what the expectation is. In this case, you're looking at about 11 ticks, 12 ticks, and if you want 20 ticks or 30 ticks, maybe it's going to happen, but it's not the expectation. The expectation would be 11, 12 ticks, maybe even a little bit more conservative, like 10 ticks. Now if you look at the stop cannot be the same as the current conditions because the market is already telling me it could move up or down between 11 or 12 ticks. So if my stop is equal or less than that, I can get stopped out prematurely. Now I've sped up this video here because obviously I don't want to waste 20 minutes of time showing you the outcome. But the bounce trade as well as the double bar long trade indicates that there's no reason for me to go short, only to go long. And the software, the Atlas line software, produces these signals and keeps you on the right side of the market. In addition, if this trade happens to either take too long or give me what I call a prove it stop or a catastrophic stop, I want to protect myself and get out of this trade as soon as I have any indication that the trade is not going in my favor. So for right now, none of the stops are hit. I'm going to stay with this trade, and at the end of typically 20-25 minutes, if the target isn't reached, you're out of the trade. I call that a time-based stop. I also think that using the bar timer, which I recommend, I just added it here to the chart, is very important. Now I'm going to stop this video here for a moment. I'm going to explain to you what's happening. Okay.
Target filled.
So what are we looking at? We have the Atlas line software giving us these signals. You see double bar long, you see bounce long. What do they mean? They're telling you to go long, basically using price action. The price is above the Atlas line. The orders are based off closing prices of these candles. They're specific, you can use market orders, but you're long. I teach the bounce and the double bar long trades, how they are created during the training. That's included with the Atlas line purchase. Most of you already know how it works with 2 candles closing above or below the Atlas line or bouncing off of the Atlas line. But remember, even though we have these orders to go long, we need to absolutely manage the trade. 3 very important parts to this. The target, which is about 3 points, maybe a little bit more conservative, 2 3/4 of a point. A stop, which is not just price based, but a stop that keeps me in the trade, provides me proof that the market is still going in my favor. I call it a prove it stop, and within the next 4 or 5 bars I need to get out of this trade. I call it a time-based stop. I'm protected with a stop strategy. And once the trade is finished, we may have pullback, strength trades, more bounce trades. The price may now cross back below the Atlas line, which will create a new order to go short. But more importantly, understand why you're entering long or short. It should be all planned out for you in advance. I like it on the E-mini S&P, but you need to have 24-hour data. If you have any questions, feel free to email me. Remember, the next mentorship class starts in August 17th.